Explore exactly what it takes to become a successful day trader and the power of consistency from the minds of the trading's elite. This is the Beyond the PDT podcast. Here are your hosts, Bryce, Tuohey, and Matthew Monaco.
Welcome back, ladies and gents. This is episode 19 of the Beyond the PDT podcast, and our guest is Brian Lee, known as Brian Lee Trades on Twitter. Brian was previously a guest on episode 7, but since we interviewed him only 3 months ago, he has had incredible consistency as he has honed in his trading skills, really focusing on risk, and the R values he uses when trading are standing for risk. Particularly, he's focused on adding into winners, while maintaining just a 1R risk per trade, but allowing him to get up to 5 or 6R return on every trade. Brian talks a lot about this in detail, so I'm going to let him explain it, but very notably, he had a 40R week, which was better than his entire June, where I think on his Twitter he had 38R return in June, and one of his weeks in July he had a 40R return, and he was able to just see this exponential growth by learning how to add into winners and all the risk calculators that he has developed on an Excel spreadsheet. One very exciting thing to note before we dive into this episode is we are officially doing a giveaway with Benzinga Pro, and you can earn up to a 3-month subscription for their news service. If you don't know, Benzinga Pro is a news provider, meaning they can alert you to the fastest news on whatever stocks you're looking for or just generally in the market. It's an absolutely fantastic service, and you can sign up for a 14-day free trial anytime. But if you enter in our giveaway, you can earn up to a 3-month subscription to one winner, and then we're also giving away some Beyond the PDT merchandise, specifically a really cool baseball cap and a Beyond the PDT t-shirt. If you're interested in this giveaway, it's very simple. Just go to beyondthepdt.com/giveaway. One more time, that is beyondthepdt.com/giveaway. And there's some very simple instructions and a form to fill out to enter into this giveaway. Thank you for listening, and a huge thank you to Benzinga Pro and Brian for this episode. Let's dive right in and listen to Brian and how he's improved so drastically since episode 7 of the Beyond the PDT podcast.
All right, let's start it up. Brian, it's a pleasure having you back on, man, first of all. For those who might not have seen the first episode with you or, might have forgotten a little bit about your style, can you just introduce yourself again for us?
Yeah, my name's Brian. I go by Brian Lee Trades on Twitter. I've been trading for about 2 years live, and I really focus a lot on risk management and risk reward and compounding. Those are kind of the things I've been really focused on lately, and the things that have kind of helped me reach a new level of consistency recently. So I try to share as much as I can about that without giving too much secret sauce.
Yeah, you had you put out some YouTube videos recently, right? You just started that YouTube channel. Those videos were pretty sweet, so hopefully you keep that up.
Yeah, part of it is just frustration because I get a lot of the same questions, but at the same time, I really like teaching people. Back in what I was doing before I was playing professional games, I used to upload a lot of videos and guides and things. And when I was a kid, I used to say that I wanted to be a teacher as well. And so I kind of like helping people. It makes me feel really proud when I see somebody reach the next level, and because they didn't know one little thing, and then all of a sudden it clicks with them, and then they're just really happy and they share their success. So I think that's really, really fun for me to be a part of.
Awesome, for sure. Oh, Matt, you look like you're about to say something more important than I was about to go for.
No, I was going to say, you still play Dota 2? Have you been playing recently since we had you on, or are you kind of focused full time on trading right now?
No, I kind of forsake the game. I don't really want to spend any more time on it, and I'm just all in on trading now. That's all I can think about.
So I've got a quick question for you, and this isn't something we really ask a lot, but I'm just curious. So you've really been finding a lot of consistency lately, and I know that's a byproduct of the hard work you've been putting in. What does a typical day look like for you? Your routine, kind of trading and life.
All right. Well, everything starts at 3:50 a.m. in the morning, West Coast time. I like to be up pretty early, pretty much as soon as the first tickers start to ramp up. I really like doing this because it gives me a chance to go through the filings and see their fundamentals and just look at what may potentially be a red flag setup and what might be a really good setup for me. And as well as I like to see them just one by one, because there's been times where I've overslept, and when I wake up, it's just like, it's kind of overwhelming and I don't know where to start. And so by doing this, it just helps me be prepared. And as I think that there's an edge just being up early, because you get to see all the price action, you get to see all the support and resistance levels form, as well as get your hand on like the locates early on. That's a big edge for me. But after that, I'll probably just watch 3-4 tickers after doing my technical analysis. I have a couple like different website tabs open where I can see the float, the filings. I like to see if they did a split recently, because sometimes the float is not really updated, things like that. And then I'll usually just watch and see if there's an entry for me. If not, then I'll wait for it to open. And then I'll just make myself a plan. So I'm like inputting into my calculator, like if I enter here and then maybe I add at this point where maybe the support breaks down, like where's my new average, where's my risk, and then I calculate like where I think the stock might go. And then if I can calculate that, I can calculate what my risk reward is. And then usually I'm trying to say that if it's at least a 3-to-1 risk reward, then I'll take the trade. And then I'm going to try to make it even better by adding to a winner on the way down, which is something that I've been doing recently. But on a really good day, I'm going to be done maybe in the first hour and a half. I used to hold all the way throughout to the end, but I kind of weighed the health benefits of being stressed out all day, waiting for my price target versus getting the quick, clean money. And sometimes, the liquidity dies down, the volume dies down, and you don't want to be stuck during that chop. Sometimes it actually reverses on you. So I like to do that, but I am willing to go the distance. For example, today there were 2 tickers that were really, really grinding out really hard, and I basically didn't leave my chair until the bell. So there are days like that as well. Afterwards, I like to get some lunch, and then I'll come back and basically just go straight into my review. And I'm usually like looking at what I did right, what I did wrong, screenshotting everything that gapped up, checking out if I missed anything, if I made any mistakes. And then I'll tally it all up, like look at what's my net realized gain, which is something that I talked about a lot, which is a lot of traders, they like to report their gross P&L, but I think that you have to be able to look at like what is your commissions, what does your locates look like on top of your P&L, because I've had friends where 50% of their profits are locates, so you have to really understand what that means to a trader. And for me, that just happens to be something like 10% or less. So because I like to hold for a bigger piece of the move, so I can look at a lot less shares. And then after that, I just wind down, have dinner, then do it all again the next morning. And then by Thursday, Friday, I'm like very worn out and just need a huge nap.
So over the weekends, are you still doing trading related stuff, or are you just kind of taking some time to enjoy some free time?
Depends on if I have a chip on my shoulder. So if I lost on Friday, I'm usually grinding pretty hard. If I win, sometimes I don't really do anything. And then I used to try to spend as much time as possible when I was learning, but now it's kind of like I know the extent to which I can refine my process. So I usually at the end of the week I'll do like a weekly recap. So I'll go through all my charts and then write a little bit of summary of like what does this week mean to me, so that like in the future I can go back and be like, oh, this week I was going through this, or this is what I was feeling. And so that kind of helps me sum up what the action was and where I was in the journey. And then if I feel like there's not much I can really do beyond reviewing, then I just wait until the weekend. But there have been plenty of times where I get really, really frustrated with my performance not being perfect, and then I'll just grind really hard.
Understandable. So quick question, and just something I'm curious about, and it's not 100% related to your process, but something you were mentioning earlier while you were talking was that, doing your calculations and whatnot, you'll be looking for different price targets, where to add and whatnot. I'm just personally curious, do your price targets come off of like fully technical, like just the chart, or do you have actual calculations? And if you do, you don't need to go into that, if you want to keep that a secret, but just curious.
Well, there's a couple reasons why, but a lot of times it's technical, definitely. There are times where, let's say that an offering just hits randomly. They'll literally tell you the price that you can cover. Like there have been times where it's like, oh, at $2, we're trying to sell this many shares and it's at $4, so you could just hold, and that works out really beautifully when they tell you straight up. But generally, it's some sort of technical level, and it's also based on statistics as well, because generally tickers try to give back a certain amount of gains on average, and you could just tell by looking at their daily charts and see, what kind of ticker are they when they gap up? Do they like to give it all back? Do they like to give it back within 2 or 3 days? Do they have like a breakout that's possibly going to act as support, or some kind of averages? I like to use what's simple, because I learned that when you're trading, sometimes the most reliable indicator is the most simplest one, because that's what everyone's looking at. So I like to be in tune with what everyone's looking at. And then sometimes you'll notice that like let's just say a certain moving average will conform to the chart. And I may have several moving averages up that work on different charts, but on this particular chart, that moving average works. So that I can use that then as a guide to see, okay, is the trend changing? And if so, then maybe I want to cover partial or something like this. So I like to just keep an open mind and see what like the chart is telling me, basically.
Great stuff there, man. So you also mentioned your calculator for your R values, which are, risk. And you did a YouTube video on this. But could you just break down, what is R? Because it sounds kind of weird if you've never really, looked at risk or trading in that context before. So could you break it down for us?
Yeah, so R is basically standing for risk, and it's kind of a way to quantify how much you're going to risk on each trade based by detaching yourself from the money. Because a lot of times, if you think about like, oh, I'm going to lose a couple $100 here per trade, or I'm going to make a couple $100 here per trade, you might kind of cloud your judgment. So that's what I do. But really, the concept is that you're using a fixed percentage of your account, and the way that I like to do it is somewhere between 1 and maybe 3%, where 1% is pretty safe, 2% is pretty aggressive, and then 3% is very, very aggressive, like super aggressive. And kind of the reason why, the math behind it, is that if you risk like a flat 2% of your account, around 50 trades, you're going to be back to zero, right? Something like this. So you want to, it's going to be more than that, because every time that you lose 2% of that's a lot less. But the idea is that you have a idea of your risk of ruin, which is a concept where, it can be any number that you want. You could say for me it's PDT. For you, it might be $0. For someone, it might be losing $1,000. It's just whatever you want. And when you can kind of define how much overall of a loss, a drawdown, is important to you, then you can define like how much you want to risk per trade, so that you give yourself a little bit of a buffer, so that you can, make mistakes and not feel so much psychological pressure, because it puts your mind at ease. And if you're feeling pressure, then you're really going to make some messed up decisions. And I think thinking about the money especially is one of those poor psychological mistakes, because once it means something to you, then you're really going to second guess yourself and try to maybe exit a bit too soon, things like that.
Gotcha. Is every trade for you then risk 1R? Or is there any trade out there, maybe you'll be like, I'm going to risk 2R on this trade? Or is it always, just disciplined 1R for every trade that you take?
Yeah, so I like to risk 1R per trade, but there are ways to manipulate that. And that's just that's the whole risk reward game that I've been exploring recently. Basically, the way is that you can double your size or triple your size, whatever it is, but as long as you stick to your risk, that is, then kind of, well, once you, let's say you have 1,000 shares, right? And it goes 10 cents against you, maybe you lose $100. If you then double up to 2,000 shares, your average risk would probably be like 5 cents. So whatever your average cost is then, plus 5 cents, that's your new risk, where if you cut it there, it's minus 1R. But the thing is, when you go to your price target, your risk reward is probably, really, really much more significantly larger than if you just held the trade all the way through. So it's kind of like you can put on big size and risk the same amount of money, but you have to do it in a smart, kind of tactical way and in a methodical way. And usually that works best when you're kind of trend following, not something that's very volatile, just going up, 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 down, up, up, down, up, down. You want to see like lower highs or higher lows, whatever, if you're long or short. And when you're able to confirm a pattern like that, you're going to be able to add on pops or short or buy on dips, and then just bring it to your price target with a really nice gain. But I've seen people say like, oh, if it's an A plus setup, I'll risk like 3 or like 6% of this trade. But for me, I think that's too wild of a jump. I think that when you're sizing up, you really have to be considerate of like your tolerance. And for people who are first building their tolerance for risk, I think you can't just be jumping from like $100 to $300, because it's going to throw off your whole expectancy. For me, it's all about like, if I traded this setup 100 times, I'll be profitable because the risk reward's in line, and I know that my win-loss ratio is synergizing well with that, and then I'll be able to be profitable no matter what. So I don't like throwing a wrench in that calculation.
So, still kind of going on the risk, and are there times where let me rephrase that. Is your risk always based on a percentage, or is it ever based off of a technical level? Or is it both sometimes? Do they work together?
It's both. I try to start on a technical level, because that's where the trend will either reverse or kind of begin. And then once the trade's in my favor, I'm gonna kind of dismiss that technical level. Of course, I can kind of sometimes synergize it where like, oh, I know that if I add at this point, it'll line up with maybe like high of day if I'm short, or a lower high. But that's not always the case. So that's where studying your patterns comes into play, where kind of like what to expect, where things might bounce, and not get too greedy in your ads. So I don't really add too many times. I'll add maybe 1 to 3 times, usually 3 times. And that helps me be a lot more targeted on where I'm going to add in, and kind of be able to calculate where my new risk will be. But usually it doesn't work out so cleanly. And sometimes you do get stopped out because you mess up and you didn't get patient for your entry or things like that. But if you can find and identify a system where you're looking for those pops, you're looking for those dips, and you know where to add, like usually those are the best spots. And it's almost like, at least with what I trade, it's usually the best spot to just lower your risk down there, and it usually doesn't retest again, so it's pretty safe.
Awesome. Okay.
Are most of these ads, sounds like you're adding to winners, but I just wanted to clarify that. Do you ever add to losers?
No.
I mean, how does that affect your R?
No. I tried it. Like, I tried to start really small and then have my second entry kind of be heavy so that I can manipulate my average cost. But I realized that there's still really bad habits with adding to losers. It's almost always going to compound your loss. So kind of what I've done is that I recognize that for me, my first entry is usually kind of like a feeler and not always the best. So I like to start on very, very small. And then if it breaks the technical level, if it spikes harder than I thought, I'll just cut it. And then a lot of times there'll be a very, very small loss. Like on Twitter, I was reporting some of my daily gains and losses and showing some of my executions. And when I do it like that, sometimes I'll cut where I'll lose like 0.2 or something like that, something very, very small. Like I don't even care about it at all. And then that way, I can always get back in. I can always get in at a better price. If I liked it here, I love it there. and it helps me from getting stubborn because for me it's such a minuscule amount of risk that it's really a paper cut. And when it does end up confirming, then I'll be able to add in, and then I'm always adding lower, basically, as a short. I'm always adding to the winner, and you'll never see me adding against my position because I just think it's just wrong because like your risk becomes so tight once you add in there, and it's not worth the stress.
Gotcha. I think I saw on your Twitter you had like a 40R week. Was that right, or was that for the entire month?
So one was a month, and then the next month it was in 1 week.
Wow.
Yeah, that's pretty crazy. You had the same R in a week as you did the previous month, June 2019. That's pretty wild, man.
It's a little bit of luck, obviously, because I can't control the market. But the way that I see it is that there's this whole new kind of path before me where in my first year and a half of trading, I was like so fixated on 3-to-1, 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 and really just trying to be perfect on my trades. Like I got the best entry, I got the best exit. That's all it was for me. But I've always noticed that people talk about adding to winners. Like some of the best traders I know, like Binder or Fateh on Twitter, if you ever seen his old charts, he doesn't post so much anymore, but he's literally murdering the stock at every single pop, and he will not stop adding until the price target. And there's people like Jack Kellogg who in the OTCs he's adding big and keeping a tight risk, and he's basically adding to winner on the long side. And of course, there's people like all day faders as well. He talks about adding when you're in the money, and I know that he doesn't show his charts anymore, but I know from some of his archives that he didn't really have the most, precise, beautiful entries, but he definitely hit the backside and hit it hard. So for me, combining like with a couple of other friends, and actually even my close friend Bear, this is probably the biggest one for me. I had like a huge fade, like 40%, 50% move, just top to bottom tick, and then he comes in for 10 minutes and he makes the same return as me. And I'm like, this is not fair. So I started to think like, why am I so fixated on 3-to-1? I understand that 3-to-1 is huge, but can we take this to the next level? Have I been ignoring something? So once I started thinking about it, I was like, you know what? I am going to add to my winners. I'm going to try this. I'm going to do it in a really basic way. So first I was like, I'm just going to double down my position, because when you calculate that, you just cut it in half. And then, so that for me, that was like stage one. And at that point, you just work on that. You see like, okay, it's not so bad. I lowered my risk, but it didn't hit. And you look at the calculation and you're like, wow, my 3R turns into 4R. And you're like, well, if I can make 4R average, then I can win a lot less. And one win wipes out, 3 losses instead of 2 losses. So then you start thinking like, how can you push this to the limit? And then simply by going from 3-to-1 to 4-to-1, like I started seeing like insane returns and started being able to really withstand some of the drawdowns and losses, and just like, wow, this is really powerful. So after that point for that month, I started thinking like, how do I get to level 2? And so I started thinking about combining different strategies. Like how does Bear do it? He's just usually waiting for a very confirmed backside. Like if a key support level is broken down, he'll get in there. But I don't know if anyone can do it as good as him, because he's controlling very tight risk, huge size, and he's always been a really good trader executing. So for someone like me, I know myself that I like to chase and I'm not as patient. So like if I did the same strategy, I'd probably get stopped out. By combining his strategy with mine, I'm able to kind of find a good medium ground, and I try to make it all systematic as well. So with my entries, like I'll try to find technical reasons to get in, and I'll try to make it as least discretionary as possible. So then, I kind of fine-tuned it where, like, at the beginning I was half and half, right? 100% full size, and then I would double down. it's basically like 200% what I was doing normally. And then I realized like my first entry should be a little bit lighter, just based on my personality of chasing. So I went lighter on my first, and then my second was heavy. And then I added like a third entry to be extremely heavy. And then just combining all of that, like I just see a way forward where in the future, even potentially I might add on every single pop like Binder does. I don't know. But all I know is that if I've seen how to get like 10R returns on positions where I normally get like 3 or 4. So I know there's a way to absolutely kill it. And let's just say I made like, 4 10R trades. That's a whole month. Like it would be very crazy.
Sorry to interrupt this episode with Brian, but one more time, I'd just like to remind you about the giveaway we are doing with Benzinga Pro. If you haven't heard about Benzinga Pro, again, it's a news-based service that can alert you to news on any stock you're watching and safeguard you from any unexpected news, or you can get good news before anyone else. It really is lightning quick, and a lot of the times with the service, you'll get the news before anyone else who's watching the stock or really any other service out there. So, to get a chance to win a 3-month subscription to Benzinga Pro, please go to beyondthepdt.com/giveaway, where the grand prize winner will get the full 3-month subscription. A second and third place winner will get some sweet Beyond the PDT swag, and a winner will be announced at the end of episode 21. So make sure you go sign up for that giveaway, and make sure you let everyone know about the sweet giveaway we are doing here. We appreciate your support, and let's dive back into the episode.
So do you not have one set R per trade anymore? Or are you just looking to see how you can capitalize every trade in a different manner? Because you said you were stuck on a 3-to-1.
Yeah.
Is that kind of your process at this point? Is take each trade as just get the most you can out of it?
Oh yeah, I mean, okay. So when I say I was a 3-to-1 trader, I wasn't just taking it at 3-to-1 every time. Like I wasn't just taking it at that level. I would of course let the stock play out, but the thing is, if you're usually when you're swing trading intraday, your risk can be quite wide. So like, even if it goes another like 20 cents or whatever, it's not it may be like another R. But when you're adding to your winners, like sometimes your risk can get as low as like 5 cents, 3 cents, 2 cents, and every single price movement like really changes how much you can make. So like, I might set out to make 4R, but maybe make 5 or 6 if I let the whole trend play out.
I see what you're saying now. Yep, that's starting to click.
Mm-hmm.
So for your R calculations, entries and exits are clearly both important, but if you could kind of pick one that you'd say is more important, would it be your entries or would it be the exits of your system to make sure you get your proper R in return?
I'm laughing a little bit because like I had this whole thing earlier this year where I posted on Twitter like entries everything, and then some people would start flaming me because honestly I didn't really know that much. I was just thinking to myself like, I'm chasing, so if I can enter better, like I won't get stopped out and I can let the trade work. But on that very same day, All Day Fader tweeted that exits are everything, and I was like, oh crap. I'm on the opposite side of ADF. And so I really thought about it, and after a while I realized exits are really I'm not gonna say they're more important because people get really touchy about this, but realistically exits are a bigger deal in my opinion, because exits are not just about profit, it's also about risk. And risk is really what the game's about. So when it comes to being a 3-to-1 trader, if you're constantly not being able to stick to your stop or having large slippage, you're not really 3-to-1 after all. You have to really be strict about it. So for me, I'm always cutting at 1R, like no matter what. Even if I think the trade's going to keep working, usually I'll just cut it and add right back in. And the thing is that you have to do that because you have to be really strict about this, not let yourself slip up, because once you let yourself slip up on that 1R, it becomes 2R and 3R. And really, those are some of the worst trades I've ever had where I let it go past my stop, because you get so uncomfortable. And on the flip side, exits really are all about risk reward, so you have the reward aspect as well. And if you're constantly taking partials or taking it off before your price target, you're completely ruining your expectation. Like for me, luckily I learned early on that I will not tolerate anything under 3R at least. So I never had that problem. But I do talk to a lot of people. Like recently I talked to James Freelander, who was on the podcast as well. And he was talking about how he wants to take a bigger piece of the move because he's always giving it away. I talked to him about how like the expectation of getting a 3-to-1 at least can really change the game for you. And I think that he's had some pretty good results with that recently. Because really, I advise everyone to look up online like a equity curve simulator and just look at the difference between like a 50% win rate at 3-to-1 and like a 50% at like 4-to-1. It's like very, very different. You can even have a like much lower win rate on the 40%. Or 4R, and you're gonna come out way ahead. So it's always about controlling the downside and maximizing the upside for me. Because if you think about it, by not exiting properly like one time, you could actually blow up your account or take a significant drawdown. So you always need to be aware of exiting.
Interesting. Okay, that's something I kind of want to look up now is the equity curve. I want to check that out and see what the real difference is. So this is kind of going to segue into a question that did get asked, but do you have different strategies that you use that are going to yield different results, or are you kind of sticking to one strategy, pattern, whatever you want to call it, personally?
Oh, so I've learned a lot of different strategies. Like some of the ones that I tried to branch out with were like first red day pattern.
Yeah.
That was like some people call them like overextended gap downs or whatever. But I realized like I started taking random losses because I wasn't really a master of that niche. So until like I mastered my current setup, I feel like I shouldn't be trading these things because I don't understand them completely. And it changes everything for me with the way I calculate my R, because I calculate based on volatility, and those usually aren't as volatile. They usually give you, like sometimes they just stop dead at like SSR or 10 or 20%, something like that. I'm used to way bigger moves, so I have a lot more room for error. So that was a big mistake for me like past year where I was trying to branch out different setups. Really, the only other setup that I like to do is when it's not a short. So sometimes I will long when like every single red flag is there for me, like especially low floats. You had Papa John, and he likes to trade those reverse splits, kind of like Roland Wolf. Those are the kind of setups where like if you're short that early, you can really get messed up. So sometimes I like to join the trend on that one and then wait for a turn. But like usually what I do will completely fail in those setups. So that's the one time that I'll take it, and I take it very, very cautiously as well, because it's just not what I do. But yeah, in terms of setups, I like to keep it really simple, just one or two things, short, or if it's not short.
All right. And so the question now that I was asked was, what do you kind of look for to quantify a setup? Like, what do you look for to actually take a trade, to enter a position? And I know you kind of went into a little bit of this earlier, but if you had to give like a short description, what would it be?
Okay. I look for a signal or like a trigger. So this is something I learned from Hammer Trader, because he was struggling a lot back in the January, February, where there was a lot of runners, like ridiculous runners. So he decided that he wanted to be more systematic, less discretionary, and then I kind of took that from him as well, because we were having a hard time like kind of managing, like looking for where the right spot to enter and stuff like that. So like for me, I have different little signals for myself. Like it could be like volume price anomalies. Like if you read the book Volume Price Analysis by Ann or something, I mean, if you look that up, that's a really good book. A lot of people recommend that, where you kind of see divergence in the price has like a lot of volume, but it's not moving, or the inverse of that, where it moves a lot, but it's not a lot of volume. So like those are anomalies, and usually points in time where you can like maybe see a reversal. There's also like technical patterns for me. Like I have a couple different like indicators and like that are back tested. And don't get me wrong, like indicators don't solve everything. They're never perfect, but for me, like understanding risk reward, like I don't need to be perfect. So I look for something with a good enough success rate, and then I have like different time frames that I'm looking at. So I like try to line it up with like fast moving 1 minute, and I like to look at 5 minutes, and sometimes zoom out a bit more just to see like what does it look like. And then sometimes when everything lines up, that's where I'll take my shot. And then I kind of have like different areas where I want to get in. Like I have like a pre-signal, so like that's just me anticipating. I get in really small, and then I have like confirmation, and even that one could fail. And then I have like a really hard confirmation that like that helps me like add in really big at that point.
Awesome. Okay, thank you, Matt. Do you have anything? That was the only question I got. I don't know if you had anything on Twitter or if you had anything else you were curious about asking.
I think our main Twitter question was from Ricky, who asked why you don't have wrinkles. But no, my question was, you mentioned a little bit about being more systematic. Even with these R calculations, it's a little more data driven. But in the last time we had you on, you said you were really visual and you kind of don't necessarily track the data for your setups. You like to take a picture of the overall chart. Has it kind of shifted in the last 3 months or so to be more data driven, or are you still heavily visual based person?
No, I still am visual based, but like for me, it's just a lot of practice, like hitting the I'll look at my like calculators. So I have on my Excel sheet, I have so many calculators, like probably over 50 different variations, with different weights. Like my first entry is heavy, small. What if I double down? What if I triple down? What if I, put on like half size double down instead? Like what's my risk at? And then like I literally go through the past 2 or 3 months, just every single ticker that I traded, and see if I used this setup, what would my risk reward look like? Would I get stopped out? If I did, was the second entry good? How much reward would I get at the end? And then like, I just, from all that I picked, like which one I felt more comfortable with. Like there are ones that are really aggressive that I can get like 12 Rs on, but I don't think I'm at the level to execute that yet. I just look at that as kind of like the next level for me. So I like to mix like comfort with just practice, because when I see it so many times just from entering in the numbers, it helps me build that like internal confidence, knowing that like it worked for the past 2 months, so it should work now.
Gotcha. That's that's hard work right there, man. Good for you. In the moment with all these calculators, what is your deciding factor on if you're going to double down, triple down, or quadruple down? Is it just a technical point in the chart that you're trying to line up with your R, or is there more to it than that?
Well, it's about being as greedy as you can be without stirring the pot. Like sometimes I've found that with like the calculator that I'm using currently, that like it gets very, very close. Like for example, today there was a ticker like TRNX, and like I was added full oversized, and when it popped up like intraday, I was literally like 3 cents away from getting stopped out. But that was me like tripling down basically from my initial position. So I like to push it to the limit, and that's just based on practice. I mean, for someone it might be stats to see like where that bounce might be and how much tolerance you can have with your new risk. But for me, like I've done it visually, so like from back testing, I know like this is kind of what I can get away with. And if I want to add lower, then I have to really consider like that I might get stopped out. So I try to add like very specific points.
Do you have any increased like nerves when you add like that? Like you said, sometimes your risk can get down to like 2 or 3 cents. Like, I mean, that's pretty tight on some of these low float movers. So like, is that more stressful for you? And if it is, like, how do you deal with that?
Well, yeah, it is more stressful, definitely is more stressful. Like definitely the way I used to trade, and I think I still recommend for people to like start at the basics. I tell people if they can get 3 to 1, that would be really ideal for you right now. Like swinging for the fences immediately is going to cause a lot of trouble because you have to be able to execute the trade perfectly from one end to the other to begin with. But once you can do that, like adding to winners, really what that comes down to is just the tests, the visuals. Just for some people, again, that will be stats. You look at it and you're like, when I add here, this is what I can expect. Because again, like I try to I try not to be discretionary. So I'll add at points where like there are technicals backing me up. Like, and one way that might be like what I talked about earlier, like sometimes like a moving average conforms to the chart. Like a really, really popular one right now is like JTrader. He has like the 7289 EMAs. Like there are occasions where that will literally like the price will pop into that and just drop. So there are people who will add into that. I mean, I don't necessarily do that, but that's kind of an example. Like it illustrates what you might be doing. So like you wait for pops into different levels. But I think that having like some kind of system or like a mix of indicators or a indicator that you've studied like immensely, that helps because you have like a visual confirmation. Like indicators are just showing you what the price is doing. It's just like in a different way. So sometimes it might be like a really basic example would be like RSI. That's like the basic of it is that it shows you overbought and oversold. Like sometimes you can just short when it's oversold or buy when it's overbought. Or I mean, sorry, buy when it's oversold, short when it's overbought. Like simple things like that. Like those offer you opportunities where you have like the highest odds. But of course, like they're not always going to work. So you really have to really think about it and study it. Because like for me, like a lot of the indicators I use, they're like customized. So like just from my own experience, I'll change the values to be either like faster or slower, and then I'm combining on different time frames as well. So like somebody trying to copy the same system as me would probably have like way different results. So it's like very, very personalized. And I've seen people, like some of my friends, like using way different systems, and I've like also kind of been privy to like some of the bigger traders. Like I've seen like some of the stuff they do, and like everyone's different. So like everyone has a different system. There's so many ways to make money in the market, I realize, and it's just about finding the one that like fits your personality. And for me, like I had the most problems like chasing or like having poor entries. So like I wanted to find things that helped me like buy at the highest odds points or short at the highest odds points instead of like just random areas. And that like really helped me personally.
I think that's awesome. So you've talked about indicators in general just a couple of times and how sometimes they conform to a chart and then other times they don't. So how do you determine, like, if it's stocks running, how do you determine that day, like, which indicator is going to conform to that chart? And, like, how long does that usually take? Do you know in the first, like, 30 minutes of pre-market, or does it take a little while to see how the price is reacting to said indicator?
Well, with that example, like they don't all act the same way because there's different types of indicators. But like with a moving average, yeah, it will definitely, you'll see it bounce into those levels and reject multiple times throughout the day. Usually, like this is intraday, not pre-market at all. Sometimes you'll see that like when it snaps these levels, like it's very violent. So you can kind of like gauge, like what is the impact of this. Sometimes it like literally holds it up the entire time. Like ADF used to post like higher time frames saying that like, the institutions, they're using this trend, like they're buying every time it dips down. I find that it really works like pre-market on the reverse split, like low float stuff, because like those stocks tend to be really, really strong when they're running up, and like they kind of defy logic in a lot of ways. Like my system's like completely invalidated. So sometimes like I'll see a low float and then I'll be like, oh, I'm going to buy this. And then like, I'll see that my system's like short it here. And then I'll short it and then I'll be like, oh, okay, I just got stopped out for like mass slippage. I should have just been long. So like for me, I'm learning that like when it comes to those type of plays, you have to separate it. And I listened to like a really like very interesting chat with traders interview recently with a guy named Corey Hong. He's a systems trader, and like basically what he does is he has an algorithm that can detect if something is like a mean reversion play, which is like most of small caps. Like, you know, they're overextended because they're gapping up. And then the other option is like a momentum play. And like what I'm realizing is that in small caps, it's like the same way. Either they have an agenda and they're gonna make it run so that they can either like increase their MVPHS, which is one of the requirements for them to do an offering. At the end of the day, they have to close at a certain price, or or they just want to like dump on the public with the offering so that they're gonna gap it up as high as possible and then run it back down. Of course, you need timing as well. You can't just know the story. You have to. Sometimes they'll be irrational. Sometimes they'll squeeze you out. But basically, what I'm trying to say is that there's two different types of plays, and like the sooner that you recognize which side it is, like if it's going to be an uptrend or downtrend, that's the key to figuring out like what system you should be using on that particular play. So like low floats are like usually the complete opposite of like a all-day fader, and so you need a different set of rules. And you can test like a different system, but like every single setup should have like its own different like systematic entry, exit, or like trend that you're following.
100%. And so kind of going off that a little bit, you know, every trader can have like you've mentioned, is going to have a somewhat different system that works for them. And honestly, any trader can have a working system, but without this risk management, you know, what is your system? It doesn't matter. What do you recommend for newer traders, maybe who are beginning to learn about risk management? Will trading with a paper account do anything for that, or is trading real money really gonna, you know, is that what you would recommend to learn risk?
Yeah, I mean, I think that it's okay to paper trade like a little bit if you literally know zero, because of course you'd just be completely gambling no matter how much practice you have. But I think that at some point you do have to like dive in and just like get your feet wet, because even with like a couple of dollars, even knowing that you're at a loss against commissions, because like nothing's going to teach you more than having the money on the line. And it actually, like psychologically as well, it hurts you more when you lose. And being hurt is important. Like when you're hurt, you grow. And that's really the only way forward in trading. You have to fail really badly to learn from your mistakes. And sometimes, like when you're paper trading, you might say, "Oh, this is a black swan event," or like, you know, I wouldn't do that live. You know, whatever it is. So you might do something really stupid and not realize that you're ingraining that habit in yourself. But if you have money on the line, you're really like much more focused. What I would recommend though for traders is like find a way to like check out like equity simulations, and like more specifically with regards to win rate and average like expectation, like risk reward, and like see for yourself like where does your account go when you're a 3-to-1 trader versus a 2-to-1 trader, and what kind of drawdowns you have. Because like for me, that was really important early on, that like when I could visualize it and see like, okay, if I actually go 3-to-1, like it's in my best interest. If I go 4-to-1, if I go 5-to-1, I could take half the trades. I could be more selective, and like I could lose a lot more, which is like, you know, a lot of traders, when they start, they're like, oh, I need this 80% win rate, 90% win rate to be profitable. But really, like sometimes I have like a 50% win rate on the day. Like I'll take like 3 or 4 losses before even making any gains, but that gain will wipe out everything. And understanding that is really, really key, because I think a lot of people, they get trapped in the mindset of like, oh, it washed out, I need to cover, or like it's a spike, I need to sell. I mean, on the long side, it's a little different because things can get really nasty. But more specific on the short side, if you're covering it to every wash, like you're never going to maximize the full potential of the trade. And I think a lot of traders realize that. Like I've seen a lot of traders making big changes, and even like, you know, professional traders like Chicana Trader, He's a he's a really big trader at a prop firm and like very nice guy. But like I remember in the past, I would see like his charts were more or less scalpy, and in some ways they are today. But like he's really been focused on like maximizing winners, and I've seen that across the board, and a lot of traders, like a lot of people recognize that. And I would like hope that I played a part in like inspiring some people to do that. But overall, I think that's where a lot of the people I've kind of grown up with Twitter are heading. Like a lot of the people that I started trading with, they're kind of like maturing, and you can see that. Like I don't really know how it is for some newer people right now, but like I remember when I was trading back then, like a lot of the traders I see on Twitter now were with me like as noobs back then, and now everyone's kind of like growing together. Because I think that like when one person likes something or retweets it, like everyone in that kind of social circle learns about it, and like it's kind of clicky because like there's different groups and stuff like that. So I know that like they're really sharing information and trying to get better as groups. But overall, like risk reward, that's huge. And if you can at all help it, I would say that wherever you want to take the price target, knowing that like, of course you don't just do this blindly. Like you look at your past charts and you're like, man, I didn't hold it. Like I didn't take the full meat of the move. There's so much left to be desired. Like once you realize that that's a problem that you're constantly having, just like cover half at your price target, let the rest run, and maybe the next wash cover half again, cover half and cover half. You can do that basically infinitely. And I think the psychology of covering half is really important because like if you cover like 75% and it keeps going, you're like, oh man, like I could have banked. If it comes against you, you're like, well, it's like the opposite. I'm kind of having a brain fart right now, but basically, like, if you do 50%, like you're emotionally placated, where it's like you took the profit, so you're willing to let it go more, and if it comes against you, you're like, okay, I locked it in like that. That's like a really good way for somebody to learn how to hold positions longer, and then eventually they'll be able to be like, okay, well, I've done this enough times to know that like it goes further than I expect, and then that way they can like see how the liquidity feels, how the prices start to move, and like feel more of the pattern. Because like when you're in the trade, you're definitely like more focused and more intent on like seeing what's going on compared to if you're not really caring about the trade. You come back later in the day like, oh, I knew that was going to happen like that. It's way different in hindsight than actually doing it live.
That just spoke like volume to me. I don't know what it was, but I think I needed to hear that because I did the same thing. I cut everything so early. And I always text Matt. I'm like, dude, why did I sell now? Like, I knew whatever. That spoke volume.
I love this conversation, first of all. But we should probably start wrapping it up just because it's already been 50 minutes. But I could talk to you for another hour. Have you had any downsides of trading with these Rs? Like, is there any downside? Because obviously we've talked a lot about the positives of it. Are there any mental hurdles you had to get over when you were going into this? Or is it really just kind of a beneficial thing that most people should try to implement into their trading?
Actually, definitely, I don't think there has been any drawdowns, really. It makes so much sense to me compared to like when I was not structured as a trader. And like I would just look at the unrealized P&Ls go up and down. And I'm like, oh, I could lock in like a couple $100 here. What the heck? But I was obviously risking like a disproportionate amount, like too much, really. In fact, like in a scalpy type of position. And but once I learned our system, it really helped me think like, I don't need to think about the money. In fact, like most days, I don't even know how much I make until the end of the day. Actually, on the week that I made 40R, like I didn't even think about it. I was like, I don't even look at the money. I look at the R, and I'm like, oh yeah, this R is so good. Like. It takes my mind off the money. I don't think about it at all. And I think that's really powerful. And like, recently I've just been talking to a lot of traders, just getting into calls with them one-on-one. And like, I've seen some people telling me like they switched to our system and like it helps their mind so much because they're able to just set a hard stop and not really let the trade play out, not stress out about it. And then understanding the relationship of risk to reward, knowing that like, okay, I had a bad day. I set my max loss to -2R on the day, whatever it is for you. Like, I know that if I make one good trade, one 3R trade, it will make it all back. Like, this is the kind of like emotional padding that people need, because like losses can be really devastating, and they are for me too. Like if I had a really good week, I had a really good month in June, right? And then like in July, when everyone's going on vacation, there's like half days and stuff like that. I was taking trades, and I was like, these aren't really A+ setups. People aren't even here. I shouldn't even be trading. I should actually just be enjoying my weekend. Like, I take those trades, they don't work out, and like for the weekend, I'm just like, my mental capital is just completely drained, like as if nothing happened, And so, I like to think in R's because at the very least, even when those losses really affect your mental capital, even just one little loss, I know like I can logically see a way out of it. And I think like, that's where a lot of like psychological problems happen for people, where they're like, I need to make this money back on this day. That's revenge trading. It's like oversizing to overcompensate, like just to go back to break even, just to feel good. Like I don't feel like I have to do any of that stuff, because everything about my risk reward is like defined. I know exactly where I'm gonna cut, and I know exactly where I'm gonna take my profits and how much that means to my trading. And the more and more I work and develop on my risk reward, I'm like, if I think right now my average is like 5R per trade. So literally that 1 5R trade just wipes out everything. Like some days I'm down like 3R already by the open. And that's just me like making mistakes. But like I know like a huge part of my philosophy this year, since like being humbled by the market, is that like knowing myself, knowing that I'm going to make mistakes, they're inevitable. I see so many traders being like, oh, I'm going to be so disciplined. I'm going to like do this or that. Like I need to be perfect. And I think that like that's naive, because really the one time is all it takes for you to lose control. And like that's really all that I think about now, is just how do I allow myself to make mistakes? Just like that small entry, because I used to add in heavy, and then like if the move is completely still front side, sometimes they'll skip like a lot of levels, and then you're down 1.5, 2, sometimes even 3Rs, and you're like, oh man, like that. And then I realized that it just wasn't working for me. So like you have to realize like what are your strengths and weaknesses, and then like really incorporate that into your trading, and realize that like you are flawed, and that you need to find a way to get yourself out of that situation or prevent it.
Good stuff, man. I love everything you're saying here. My last question, you already touched on it just a little bit, is what's next going forward for you? We asked you this 3 months ago, and I mean, your progress has been, it's been awesome, like to say the least. But what's like one main thing you're going to be focusing on, going into the future, into the end of 2019?
Mm-hmm. For me, I'm really just refining like my technical system. Like adding is new to me, and so I'm very much a novice at this. Even though I've done quite a bit, I see it as just working on different levels. The really nice thing about it, the most inspiring and motivating thing about it, is that I'm able to recognize like what is the next level. So for me, I can see like where I'm at, where I was, and then where I could be. And I'm just trying to like find the right balance of sticking where I need to be until I'm able to level up, because like I see some people trying to level up too quickly and potentially putting themselves in harm's way. For me, like after that month, like I did try to find I did try to level up a little bit as well, and then like I had kind of like a couple of small losses, not big losses, but like losses in the sense that I got stopped out before I could nail like a big trade, because I was trying to like maximize a little bit too early, and I'm not quite comfortable with that yet. So like it's just about like playing out the risk reward game and seeing when you're comfortable at what it is, where you are at now, and then taking that to the next level, pushing your limits. And then that's just going to take a lot of experience. That's going to take a lot of back testing and like confidence building.
Solid.
Awesome, man.
Yeah.
Yeah, this is going to be a sick episode. Do you have any last words or advice or just anything you want to say?
Yeah, so I think that something that I realized a bit too late was that there's something to learn from everybody. And like when I first got into my methodology, I used to like kind of turn a blind eye to some of the things people were saying. Like, you know, they were always there in front of me, but I just couldn't see it. And so because I was just not open to it. And like, I think that when I started opening my mind to like different possibilities of how different people trade and how they profit and how they succeed, and just learning to incorporate that then into my strategy, like I think that was a game changer for me personally, because like trading is very personal, and a lot of people they look at like their system and they try not to deviate it from it. But like, I don't know, I just realized there's a lot of wisdom out there from a lot of traders, and even from people who you wouldn't necessarily expect. So like, try to talk to as many people as you can trading the same stuff, and learn like what's like one really good thing that they do, one really good thing they know, and like amalgamate that into your strategy. Because at the end of the day, your strategy is going to be like what speaks to you, but like do not ignore what's out there, like indicators, for example. That was something that I ignored for a long time, or adding to winners. And like had I started adding to winners like before, you know, I had the right expectancy 3-1, but you know, had I started adding earlier and started taking that advice instead of being like, you know, that's stupid, you're lowering your risk. How can you stay in the trade? Like, you know, I'm there for the whole move. I'm not just taking the small piece, whatever it is, whatever like mental thing that you're stuck in. Like once you're able to like realize that everybody can teach you something very, very important, like then you can see like huge growth in the way that I did.
Awesome. Love it.
Yeah. Beautiful. I think that's a great thing to end on right there, man. That was pretty sweet.
All right. Thanks, guys.
Welcome back, guys. It's Matt again, and thanks for listening to the entire episode with Brian. It was one of my favorites, and there was a ton of great advice dropped in the episode. As usual, if you have any questions, comments, or concerns for us, please hit us up at beyondthepdt.com, and make sure you enroll in that giveaway. There's really nothing better than free stuff out there, and the giveaway is extremely easy to enter. You simply have to fill out a form and subscribe to us on whatever platform you prefer to listen to us on. That is all today. Can't wait to catch you on episode 20.